Hey,
Hey there. Soon as I get settled here, we will get started because I'm on a crunch today. So
okay. Is
get
it just you
rolling.
and I?
What's that?
Is it just you and I?
I hope not. I've been very clear on the meeting and its rescheduled time, but hopefully not. Let me ping that message real quick.
Like
Let's
you're,
roll, team. Credit spread time. All right, give me one sec.
yeah, sure.
Okay. Um, all right, so I am just getting my charts pulled up here and then we will get rolling. Shout out to my oldest daughter who made my background. she's a she's a big Minecraft fan and I promised her that I would use it in my next broadcast, so you're all welcome. But there you go.
Looks, I thought you were in Disneyland.
Yeah, it kind of looks like that, right? Oh, I told her to make a Viking castle for me. And so that was the result.
Nice.
There we go. All right, so I am just pulling up our notes here. And hey, you know what? If it's just you and me today, we're gonna have an awesome time, and you're gonna learn a lot.
Awesome.
So we will figure it out.
Okay.
Let me pull up the agenda. All right, so yeah, it's been a minute since we met. Did you have any questions or comments or concerns about the first class, the definitions, the terms, the ideas behind math-based option trading and how all that works?
Um, honestly, I'm a little uncomfortable, but because I'm not completely well versed with all this stuff. I've taken classes, I've done stuff with Jeremy as well, and listened to the videos, but it still
Okay.
hasn't clicked for me. So
Do you have some specific questions about what hasn't clicked or what you didn't understand? Since it's just you and me, we can really dialogue today if you want to. You can get a lot out of this.
yeah, I appreciate that. Um, I guess it's better for me to just ask questions as we go along.
Okay.
That'd be better.
All right, no problem. Well, I'm gonna log into Tastyworks here so that I can start breaking down the option chain.
Yeah, I created a Tastyworks an account, so I have it open on my screen here.
Oh, great. Okay. How do you like it?
I fooled around with it. Looking at some of the different tabs and stuff. It looks interesting. I really don't. It's very new, so
Sure. Yeah.
it's gonna take some getting used to. I was trying to get rid of the front page where it says follow. I don't know if you have that on your screen, but on the home page, it just has a list of people who post their trades and trying to attract people to follow each other. And I just wasn't interested in doing that. I couldn't
Yeah,
figure
I
out how
have
to
no,
do it.
I honestly have no idea what you're talking about, so that's interesting.
I could do share screen with you. Can you see it?
Okay, yeah, give me 1 second here. Okie dokie. Yeah, go ahead. We'll do a little Tastyworks Q&A here real quick.
Can you see the screen?
Yeah, all right. Well, so you're on the website, right? All right.
Yeah.
Yeah, so what you're going to want to do is download the desktop application.
Okay, I did that as well. You want me to be on that?
Well, that's what I'm going to work off of. I think it's much easier to use. I actually also found the website to be the web app. I found it to be difficult to use. Let's just say the web app is designed more for like a social interactive trading experience, similar to
Oh,
Robinhood or what Doe used to be. So they've kind of gone that direction with it. But the desktop app is what I'm going to teach from and what I think is their best product. So
okay. Let me see
that
if I can.
probably would explain some of your confusion because honestly, I've logged into this version of Tastyworks maybe one time in my life. So I actually don't know how any of this all works. But I'm pretty expert with the desktop version. So I'm
Okay.
sure there are similarities. You know, it would just take it would just be a matter of getting in there and figuring it out. But why bother when I've got the desktop version? So
Okay. Let me just do that real quick.
sure.
Take some second here. Launching version. Running. Okay. I think I got it.
Okay.
Um, it doesn't save my password. Oh yeah, this looks a lot cleaner.
Good. All right. Well, let's dive in because I want to be respectful of your time, and I do have some place to be. I have to log off right at about 4:30 Eastern at the latest to head to a rehearsal. So we will
Sure.
away here. So we left off last week talking about basically the difference between historical move and expected move. All right. And so we basically covered the concept of the idea that that's probably the most confusing way to say that, but we basically covered the idea that as we look out into the future, the exchanges use mathematical models to project a likely range of outcomes for every stock. right? So that's where I had the, the picture of the cone. And so the way that those things are priced, volatility is always overstated in there. They're always going to be, there's always going to be more fear than there probably needs to be. The general takeaway from all of that is that options, in a vast majority, isn't always true. Okay, nothing's ever always true in the stock market, but for the most part, options usually tend to be overpriced, which means that if we're not selling options outright, which is actually a lot of what I do and how I make a lot of my money, if we're not just going straight to that route, if we're buying options, we need to be setting our strategies up in such a way that we can still take advantage of the fact that options are overpriced and not get dinged by that. So how do we do that? That's where we're going to start getting into the details of the strategies that we're going to go over here in the next 4 weeks. The next 1, 2, 3, 4, 5, 6 weeks will be strategy specific. We'll be looking at 5 strategies over those 6 weeks. Actually, 6 strategies because the last one is 2. So, and then the last week will be review, some scans, some Q&A, that type of stuff. All right.
Okay.
So the first strategy we're going to look at is one of the more easily understood option strategies. It's a credit spread. So, Sean, since you're the only one here, do you know what a credit spread is and how it works? Describe a credit spread to me.
Okay, how I understand credit spreads, it's a two-leg strategy where there's calls and puts, and depending on whether you have a bear or a bull spread, your legs, would you would buy to open with a bear, buy to open with a call, and sell to open with a put to create the spread.
Well, you have the right idea. It is a multi-leg strategy, but typically what I'm talking about more specifically, is a credit spread vertical, which means that both of the legs are of the same type of option. So we're either going to sell a put credit spread or we're going to sell a call credit spread. So there isn't calls and puts inside the same spread on this strategy.
Okay.
So let's break it. Let's go into the option chain a little bit here and look at how this breaks down. I'm going to share my screen. Okay, so if we just look at old SPY here, as we are bouncing off the 100 today, typically the most commonly understood form and most commonly traded form of credit spread, in my experience, based on what I've observed, is the put credit spread. All right, and these are popular because people want to sell puts. They understand the advantage of selling puts. However, in many situations, they're concerned about the potential risk of selling a put. So let's get down to basics here a little bit. If I were to just sell a put, let me get a different color here. If I were to just sell a put on SPY down here right now, what would be the pros and cons of this strategy?
The risk is that you would be assigned the shares if the price of the stock falls to that point
At expiration.
at expiration.
Yeah, which is an important distinction because a lot of times when I'm selling options or I'm defending puts or spreads, the stock will come down, touch my strike price, chop around a little bit, and then bounce, and I can still get away from it without taking assignment of the shares. All right, so but yes, for the most part, you are correct. If you sell a put and the stock comes down and closes below your put strike at expiration, you are going to take assignment of those shares. So that is one risk. And because of that risk, that is the main risk of selling puts. Because of that risk, selling puts can use up a lot of buy power. So selling puts is not a popular strategy in small accounts. And in certain IRAs, you can't do it. All right. Now, you can sell cash secured puts in just about any IRA. But again, then you run into that buy power issue where you are taking up enough money and they're setting it aside on that put to potentially pay for 100 shares of the stock if it does come down there. So you're not going to be able to sell very many. and then you won't make very much money, potentially speaking. All right. So one way that we mitigate this is to buy another put further out of the money. And now we've created a spread where we have sold this put and then we've capped it off by buying this put. So what that looks like in the option chain, if I were to just do this on SPY right now, let's say we're going to go to the 30 delta, which we'll get into here in a minute. I'll get more specific, but I might sell this 443 put since SPY's having a big down day today. And as you can see, I'm in a margin account right now, but it's still going to cost me $7,700. If I were in an IRA, I'd have to set aside $43,000 to sell that put. So a lot of people like the spreads instead. Whoops, let me get those back because, yeah. A lot of people like the spreads instead because they can get a similar effect and a similar strategy without the massive potential downside. So if I were to go $5 wide here, which would be the 437 put, I could sell this $5 wide credit spread on SPY for $1.28, and it's only going to cost me $127 in buying power. So you could do this in just about any size account if you wanted to. Mm-hmm. All right, so that's the advantage of, and it's called a credit spread because you are getting paid a credit. All right, so this is where option trading starts to turn on its head a little bit if you're going to do it in a math-based way. Most people are used to just buying puts or buying calls based on your bias. I want to go long, I'll buy a call. I want to go short, I'll buy a put, and you have to pay for that. All right, and that gets into what I said last week, which is that options tend to be overpriced. That premium is going to cost you. Okay, and because you are paying for the volatility premium and you are paying for the intrinsic value of the option itself, meaning you're paying for the equivalent of the stock anyway, leveraged, obviously. You're not actually buying the stock, or it would be, nobody would trade options because they would be even more expensive than the stock. But you're also taking the risk that that money you pay could go to zero if it doesn't close in the money. Right? So the value of a contract expires over time. 70% of all options that are purchased out of the money expire worthless, which we can see also here reflected in just our option metrics. All right. So for example, I think I might have mentioned this last week, but let me just highlight this just in case I didn't. As we were leading up to the idea that all options tend to be overpriced, what I'm really wanting you to take away from that is you're at a statistical disadvantage if you buy options outright. Now, that doesn't mean that you can't make money doing that. Okay, obviously, we have some very good option traders in this community that trade naked options long and do very, very nicely with it. But what I am saying is you have to be a master level tactician and technician on your charting, because you have to be really, really right, and you have to be really, really fast. All right, if the stock doesn't move in your direction and do it immediately, you're going to start losing money against time. So for example, today on SPY, if I just blindly buy a call, okay, at the money right now, this is 30 days out, it's about $1,000. Now, statistically speaking, based on the exchange's own pricing models, I have about a 35% chance of actually making money on that call. Because if SPY stays where it's at or chops around or goes down at all, I'm going to lose, right? And my break even when I buy options is my strike price plus the premium paid. All right. So this thing's got to go to the SPY's got to go to 466 for me to make money on this thing at expiration. That's why the odds are low, because that's going to add $10.
Can you show me how you got to this option chain real quick on Tastyworks, please?
Sure. Just put a ticker in the symbol up here and then click on the trade tab.
Ticker SPY.
So there's a little tiny set of tabs here to one side, and you want to
Oh,
click on
that's
the
what
trade
I'm
tab.
confused. Okay, sorry. Thanks.
No worries, no worries. All good, all good. Yeah, so anyway, that's a roundabout way of basically saying that you've got to be really, really good to just go long on naked options.
Right.
And what we've seen and what is statistically proven to be true is very few people actually are. It's usually much more advantageous to set up spreads that will give you an advantage. So what we're going to try to do is get on the other side of this equation, which means we're going to operate as the insurance salesman. All right, so we are going to sell options to people and trust the probabilities and the statistics in that the vast majority of time we'll be fine. Sometimes we won't be fine, and there's the defense and mechanics for that, and we'll get into all of that. But most of the time, if we sell options and 70% of the time options expire worthless, then without even looking at a chart, without even looking at a financial statement, I'm putting on a trade that already has a high probability of success. So then when you combine fundamentals and you combine technicals with that, whatever your methodology is, you implement math-based option trading strategies and tools into that, you come up with a very high win rate strategy or system. Okay? All right, so back to credit spreads then. As we highlighted on the chart, we are going to be primarily talking about put credit spreads since most people trade bullish. All right, so if you sell puts, that's a bullish move. If you buy puts, it's a bearish move. If you sell calls, that's a bearish move. If you buy calls, that's a bullish move. All right, so that's something that you just need to be very comfortable with quickly navigating. All right, but you can do credit spread verticals either way. Okay, so as I go through these strategies, Sean, and everybody who's hopefully watching this next week.
Tonight, actually, before tomorrow's class.
What's that?
I said, I hope everybody's going to watch this tonight because we have class tomorrow morning.
Yeah, well, the good news is tomorrow I'll be teaching a different strategy
Right.
because it's closely related to this strategy. And
Okay.
then I'll be teaching the management techniques of both of them together since there's a lot of overlap next week. So that's one of the reasons why I made this time slot one of the options, is because you can actually watch both of these classes over the weekend and be fine.
Okay.
All right. Anyway, where was I? So one thing I want to just remind everyone of, in case again I haven't said it already, I am not in this mentorship group going to focus on how to pick a stock and pick a direction. All right. I will give you guys some scans and techniques that I use in the last class because I've had so many people ask me for that stuff over the year I've been doing this here. But there are a lot of excellent moderators and coaches in the real life trading community who pretty much only teach how to pick a stock and how to pick a direction through technicals, through fundamentals, through whatever strategy or system that you want to use. That's what they teach. So my goal is not to supplant that or try to reinvent the wheel with that. My goal is to give you math-based option trading strategies for your toolbox that you can then employ. If you want to use the 10 EMA strategy, you can use a math-based option trading vehicle to do it in any and every situation. That's my goal. All right. So in this situation, on a day like today, traditionally, you might want to sell puts on a big down day like we have today. So if you wanted to sell puts on SPY, you could do a credit spread to do it. All right, and that's what we're going to be talking about is credit spreads. We're going to get paid right up front with the trade. Most people think about buying and selling stocks. It's like, okay, I want to buy a stock. I'm going to take my money, purchase that stock, and then hope it goes up and I can sell it for higher than I bought it back. Everybody understands that profit curve, right? Buy low, sell high. Today, we're going to talk about a credit spread, which technically, in terms of the options that you're actually working with, even though it's a bullish strategy, you are shorting the options. You're shorting the puts. All right, which means that you're going to sell high first if you can. Then Later, you're going to buy low. All right. So you can buy low and sell high. Most people think of trading in those terms. But what we're going to talk about today is strategies in which you want to sell high and then buy low. All right. So let's break it down. Okay. As I said, we're going to assume you've already picked a stock and a direction. All right, because there's a lot of information all over RLT around how to do that. So I'm not going to spend our time reiterating that. What I'm going to do here in this mentor group is teach you how to apply your bias using options in a high probability, high statistical outcome way. All right, so step one, as you're looking to trade credit spreads, you want to check for binary events. All right, so earnings, corporate events like Apple Day, presidential elections in particular, but definitely the every 2 years type of control of Congress elections are big ones to be aware of. All right, and you want to try to stay a couple of weeks away from those. All right, and the main reason is these are outlier events that are out of your control. In other words, anything could happen. All right, and if we're selling options, as I already said, we are in the insurance business, essentially speaking. We want to think like an insurance company, which means we really want to limit risk. Now, if you sell an option for let's just go back to SPY here. Let's sell this 30 delta put. If we're going to get paid $590 to sell that put, if it expires worthless, which it has a 70 to 80% chance of doing, you get to keep all of that $600, right?
Mm-hmm.
But what happens if SPY goes to zero? Besides the, obvious zombies in the streets and we're all hiding in our basements because the financial system of the United States has collapsed. Besides any of that, what happens if SPY goes to zero on this put? What are you on the hook for?
You keep the premium.
Well, you keep the premium, yes, but if SPY goes to zero before your put expires, you are obligated to buy shares of SPY at 442. So what are you on the hook for?
$44,000.
Yep. So you're basically risking around $44,000 to make $600. This is why a lot of people don't like selling options. The problem is the reality that you're actually going to get to that place is virtually, it's so close to zero without actually being zero that it's not worth discussing. All right. So there are ways to trade this in a safe way. I'm going to teach you how to do that. So don't get scared by the max loss, but do be aware that even in spread trading, all right, if I were to cap this off, notice an interesting pattern here. All right. Mm-hmm. Our maximum profit is $104 because that's the credit we're selling. What's our maximum loss?
$396.
It's $400. So we're risking 4 to make 1. Now, actually, I would not sell this spread. I'm going to give you some metrics to look for later in risk reward that are going to improve this a little bit. But generally speaking, when you're selling options, whether you're doing it in spreads or you're doing it with naked options, you are theoretically risking more money than you stand to make on the trade. And that's why it's a high probability strategy. There's no free lunch, right? As one of my mentors, Jim Schwartz likes to say, for every gimme, there's a gotcha. All right. So we are talking about high win rate strategies here. But if you lose, you're going to lose bigger than you can win. And so go ahead, Sean.
I had a question earlier regarding the binary issues that you raised. Mm-hmm. The Fed meetings would fall into that, right?
I personally have never traded around Fed meetings because they happen so frequently. In swing trading, it's almost impossible to make money consistently and avoid Fed meetings at the same time.
Yeah, but if a Fed meeting typically causes the market to to drop, do you use that binary event to consider which direction spread you should create? Does that make sense?
If I have positions on, I'm not worried about it. And I typically don't make trading decisions around the Fed meeting initially. If I'm looking at the markets later in the afternoon, and the Fed caused a big drop, and there's bullish candles being taken out, and people are trapped, I might consider putting on some bearish trades. Yes.
Okay.
But in terms of what I'm really going for here, I'm talking about events that could wreck your trade without your control. And as volatile as Fed meetings can be at times, over the long haul, okay, statistically speaking, they are not as impactful as especially this one right here. This is really the main one you need to watch out for. Trading credit spreads over earnings can get you in a lot of trouble because nobody actually knows what's going to happen. They
Okay.
may tell you they do, they may think they do, but they don't. And so because we're risking more than we stand to win, that's an unknown element of risk that's not worth taking, statistically speaking. So just avoid earnings is basically the general consensus. Now, obviously on an instrument like SPY, there are no earnings. So you never have to worry about that. You can have positions on in SPY anytime you want to. Without having to worry about earnings. But in individual stocks, for example, let's say I just want to pull up something with some interesting IV here. The trade desk has a big IV pop right now, but well, earnings are 30 days out. Here we go. I mean, this is IBM. We've got some high volatility in IBM right now. You could potentially look to trade IBM, but it's got earnings in 6 days. So I'm not going to do that. I'm going to try to make sure I have at least 2 weeks to get some decent premium out of a position before having to deal with earnings. All right, so that's basically the idea with the binary events. All right, let's have a conversation about volatility now, because that's the next thing that we're really going to look for. I left my water on the table. Give me 1 second. Okay. All right, so I would ask somebody else, Sean, but since you're the only one here, I'm gonna keep asking you questions. Tell me what I mean, most people who trade options have heard the idea that you've got to understand volatility and that implied volatility is a big part of option trading. Have you heard that?
Yes.
All right. Has anybody ever taken the time to explain to you what that actually means or how to use it?
Yes, but I'm still kind of hazy with it.
Okay. All right. Well, you're already ahead of most. Most people really don't have a reasonable understanding of what volatility is or what it means. So let's go back to the chart for a second and refresh what implied volatility is. Okay. So let's say that as we look forward on SPY here, over a given period of time, I don't know, let's go to March. Let's pretend that our given distribution of outcomes on SPY could look something like this. All right. This is not perfect. You know, I'm just freehanding this, whatever, but you get the idea. All right. So the range of these outcomes right here, that is the implied volatility. All right. So if SPY has a really thin projected range of outcomes, that would be considered low implied volatility.
Right.
And if it has a really, really wide range of projected outcomes, in other words, SPY's flying around all over the place, we don't know what's going on, and we're all terrified, you know, this might be considered really high implied volatility. Okay?
Okay.
Now, here's the problem. Some stocks live in a constant state of quote unquote relatively high volatility. All right, I'll give you an example. Right now, the implied volatility on GameStop in the February monthly cycle is 140%.
Wow.
So that means that GameStop's price could change by 140% in the next 30 days, which means the internet, well, the internet, that's a terrible term. That don't use that. The market makers expect GameStop to be, right now it's trading at $110. They expect GameStop to be anywhere from roughly $275 all the way down to zero.
Right.
They realistically expect a range for GameStop anywhere between 0 and like 300, which
That's
seems insane.
insane.
Yeah. And obviously for SPY, it's not that high, right? The implied volatility for SPY in the monthly cycle, which you can find on every broker on the option chain right here, where it says IVX, that's the IV index.
Right.
That's the implied volatility index. This is the actual volatility for the instrument you're looking at. And because it's over a given time, the size of the cone changes based on how far out in time you go, right? So you've got different cones for different time frames. That's why every one of these expiration cycles has its own implied volatility. See
Can you
that?
explain, sorry, quickly, but since we're on this, can you explain why the January 22 monthly IV is 26.7, then the February is 22.8, but then for the March, it goes to 24.
Yeah, that's all based on historically predictive math models and pricing simulators that the exchanges use. So right now, IV and SPY is a little bit inflated because we're selling off right now. But the market is anticipating that prices will stabilize and either go higher or chop sideways for a little bit. So that's why the intermediate implied volatility is a little bit low. This is somewhat affected by volume as well. There's just more trading happening up here. But then the further out in time you go, the less we actually know about what is happening. And so then IV starts to build again because we don't really know what's going to happen out further out in time.
Interesting. Okay. Thank you.
Yeah, sure. So anyway, but you can see the difference, right? SPY's got a February IV index rating of 22.8% compared to GameStop's whatever it was, 141.2%. All right. So here's a question for you, Sean. Is the volatility in GameStop high right now? What do you think?
Extremely high.
And I would say no, it is not. It is actually relatively low. And this is where people don't quite fully grasp everything that's going on with volatility. I'll give you an example. So when I am trading a volatility curve, all right, let's say this is the volatility on SPY right here. It goes up, it comes down. It goes up, it comes down. And volatility tends to fluctuate something like this. If you look up an implied volatility indicator on your TradingView charts, you'll get a column that looks something like this at the bottom. Okay?
Like VIX. Like VIX?
No, VIX is its own separate thing. If you go to if you go to TradingView and you go up here to indicators, and you just go to, wait a minute. Yeah, and you just search volatility. If you throw a volatility index up there, you can kind of see what I'm talking about, where it kind of goes up and down, up and down. So anyway, I'm not asking you to do that. It's not something that I use. But it is an example of how volatility works. Let's pretend this is the volatility on SPY at 22.8%. The volatility on GameStop is, whatever that is, 7 times wider, okay? So the volatility on GameStop might look something like this.
Right.
Where it's just crazy swings, right? And GameStop generally lives at a higher volatility. In fact, realistically, the volatility on GameStop probably looks something like this, where it just never even comes down to SPY levels. All right, so here's the question, and here's the problem. Most people base their volatility decisions on the IV index because it's all that they really are used to using. It's all that we used for years. But there are new metrics coming out that are much more useful when it comes to volatility. So the question is, Sean, if I were to sell an option right here at this exact moment in time, would I want to sell an option in GameStop, or would I want to sell an option in SPY?
It depends. Are you bullish or are you bearish?
Well, you can sell a call or a put, so that doesn't matter because you can flex the position to reflect your bias either way.
So I would I would pick this I would pick GameStop.
Okay. And that's what most people do. All right. Unfortunately, you probably missed an opportunity.
Okay.
All right. Because you're going to probably get more premium here, but what's going to happen to the volatility curve on GameStop?
It's gonna go up.
It's likely to go up. It
Okay.
does, we don't know for sure that it's going to go up, but we can look at GameStop's volatility track record at that moment in time, and we can see that it is very likely to go up.
Okay.
And that is the critical point. If you are selling high, remember volatility is 1/3 the component of an option price. Time decay and the underlying stock is the other 2/3. But volatility is what gives option prices a lot of their fluctuation. If I'm selling high, I don't want to buy higher. I want to buy lower. As an option salesman, I want to sell high and then buy low. So we trade volatility in many of the same ways that we trade price, which means the opportunity here was actually in SPY. Even though you might not get paid the same amount of premium, the statistical likelihood that you're going to win is much higher here. All right, so I want to pause here for just a second because I don't want, well, first of all, do you have any questions over this so far?
No, I think I understand.
Perfect.
Sell high, buy low.
Yeah, and that goes for volatility as well. And this is one of the ways in which I start to stack the odds in my favor to a point where I can win 80, 90, 95% of the time because of the fact that I leverage volatility correctly. Just because something has high volatility and high premium doesn't mean that it has high volatility for itself. The volatility here at this moment in time for GameStop is low for GameStop. If I want to sell a put on GameStop, I want to do it up here. That's where it's high even for GameStop. All right.
So the February 22 put at the volatility 141, you said this is low. So that would, and you would know that from experience and from looking at history of where volatility would be.
You would know that from one very easy number. I'm building up to it. No worries, no worries. I'm glad you're thinking through it. My general point here, though, is you want to lean into the statistical advantages of selling in high volatility environments. And simply because you might have gotten paid more on GameStop at this moment in time, you were more likely to struggle to find a profit if there was a volatility increase. Now, one thing I do want to say, little disclaimer, I don't want to discount direction. All right. So if you're a master chart technician and you've got a stock and a bias and you just want to go long, first of all, you might be better off just buying shares if you have that strong a conviction about it. But if you don't and you want to play it neutrally with selling a put, if the stock goes straight up after you sell the put, are you going to make money?
Yeah.
Of course you are. Absolutely. Direction still matters. So I am not saying that you cannot sell options and win in a low volatility environment. I am saying that it's harder and less statistically advantageous. All right. So if you consistently sell puts in a low volatility environment, eventually that's going to burn you because there's going to be a vol expansion and you're going to take a loss. That's going to eat up a big chunk of your winnings. Whereas in my case, if I'm consistently selling puts in a high volatility environment and I like the chart, I'm going to win more often. All right. So there's a little bit of a trade-off there. But the question obviously comes back to what you asked, which is how do we know then if this information here doesn't tell us the whole picture? How do we know if we're in a high or a low volatility environment? And the answer is we have to measure volatility against itself. All right, most of these volatility index numbers are benchmarked against the broader markets, which means GameStop is super volatile compared to SPY. We already know that. But it doesn't actually tell us how volatile it is compared to itself. And that goes back to that volatility curve. I want to sell volatility when GameStop's volatility is high for GameStop. Mm-hmm. And the way that we do that is right here with the IV rank. All right. So if you are a Thinkorswim user, you might also have the IV percentile number. All right, that one also can work. But basically, you're looking for IV rank or IV percentile. Those two numbers will inform you about where the volatility is, generally speaking, given the information of the last 6 months to a year. All right, so for example, right now, the IV rank on GameStop is 5.8, which is very low. All right, but if I go back over to SPY, because we're having a big ugly selling day, you can see that it's at 42.8 on SPY. So SPY is actually experiencing a rise or a spike in volatility today as we are selling off like a madman in the markets right now. So today is a great opportunity for selling options in SPY because people are emotional, they're freaking out, they're scared, which means they're willing to pay even more to protect their positions. Whereas in GameStop, there's not a lot going on in there. And even though you might get a lot of premium, you're going to have to pay a lot of premium to get out of that position. And if there's a volatility expansion, it's going to work against you. That means that all you're really banking on at that point is direction, in which case you probably should have just traded stock to begin with, because it's going to be, more efficient and it's going to be easier than trading options if you don't use volatility correctly. You with me so far?
Couple of questions.
Fire away.
So we said that the higher the IV rank, the more volatility we're experiencing.
Correct.
So therefore, it's a good time to pursue this this ticker, this position, because the chances of getting how do I put this? Selling high and buying low is greater.
Correct.
Okay.
Yep. Yeah, this is a good time for selling options, in other words.
Right. Second question is, if you want to be strategic about it, does Tastyworks allow you to find stocks that have a very high IV rank?
Absolutely.
Okay.
Yeah. So there's not a scanning tool in here. There are free scanning tools on the internet that you can use to find high IV. I think one of the free ones that I recommend if you don't use Tastyworks is barchart.com, because they have a lot of tools. And so if you go to barchart.com, you can, if you pull up any ticker, you scroll down to the options overview section. Come on. Which is going to be about halfway down the page. Okay, right here. You will see the IV rank and the IV percentile there. So I believe you can scan for this. If not, you could probably do it as a premier member. I haven't really tried, because what I'll tend to do is even though, like I said, Tastyworks doesn't have a built-in scanner, you can pull up watch lists first of all, you can look up any specific ticker. So you could have your own watch list of, hey, what is going long on the 10 EMA strategy right now? And then you can just check the IV rank up here in the corner. But if you wanted to create your own watch list, you can import it. One thing I like to do, I like to use the high options volume watch list, which we'll get into in a minute why. Okay, I like to focus on liquidity when I'm trading options. But you can add IV rank as a column and then sort by it. So I have the highest IV rank tickers in this watch list at the top. And then I can just scroll I can just read my way down and see opportunities that I might want to be interested in.
Got it. You showed on bar chart, you showed the difference between an IV rank and an IV percentage. The numbers were different. What's the difference between IV percentage and IV rank?
Yeah, they're different math formulas. So
Okay.
one is more sensitive to outliers than the other. All right. So here's the general rule. Without going too deep into it, because it can really get into a cross-eyed statistics class if we do. Without going too much into it, here's the general rule for that. Okay. IV rank. Good most of the time. And best in trending markets, which is what we have most of the time. The indexes tend to mostly trend up. All right. So in all of those environments, I prefer IV rank because it's much more sensitive to what we call outlier moves or large spikes in volatility that happen quickly. You can get in, find an opportunity with IV rank, snipe a trade, and get out. All right. IV percentile has a smoother curve, which makes it less effective in normal markets, in my opinion, but best after shocking market moves because you need that smoother curve. All right, so the most recent example of this that I can think of was COVID. All right, leading up to COVID, I was trading on IVR. After COVID, the volatility in COVID was so high that by using IVR as a measure, it looked as though there was no opportunity in the market at all, that all volatility was completely gone and stayed gone for a year. Now, was that really true?
No.
No. But the high volatility numbers of the COVID crash skewed the IVR number for a good 12 to 15 months after the crash. So in the aftermath of COVID and up until about probably May of last year, 2021, I was using IV percentile because you were going to get a little bit smoother curve and a little bit better answer for when volatility was giving you some opportunities. But the rest of the time, I pretty much just use IV rank.
Okay.
And I'm back to IV rank now, and I will stay there unless we go down another 30% in the markets. All right. So here's the basic rules then. Now that we understand, now I wanted to break this down because this conversation around volatility will apply to every trading strategy we do going forward. All right, so it's important to understand how to interpret volatility properly and how to position yourself to be on the advantageous side of it.
Okay.
So my rules of thumb, which, well, these are some good rules of thumb. I didn't invent these, but I did curate these. All right, 30 or above, potentially great time to sell options. All right, if the IV rank is between 20 or 30, you want to be choosy. You want to double check and make sure the premium you're getting is actually worth it, which we'll get into here in a minute when we break down credit spreads in more detail with our last half hour.
Okay.
All right. If IV rank is under 20, I don't sell options. I don't care how good the chart looks. I don't care what news came out or is coming out. Does not matter to me. I do not sell options if the IV rank is under 20. If I want to trade that instrument, I will use a different setup. I will not use a credit spread. I will not sell options into IVR that is under 20, me personally.
Okay.
Okay. The next big thing to talk about is liquidity. All right. Math-based option trading is a more active style of option trading, which means sometimes we're going to be doing some adjusting. Okay. And we're going to get into this more in 2 weeks. Well, actually next week. I'm going to talk about debit spreads tomorrow. And the next week, I'm going to talk about how to defend and manage spread trades as a whole. All right. And you will see at that point how I tend to look at option trading more from a positional standpoint and less from an open and closed trade by trade standpoint, which means I'm okay with, for example, say rolling options. Some people don't like rolling options, but I think once you look at the math behind how it can work, I think you might want to at least consider being open to it. But if you are moving in and out of all these different options around a position, you've got to have good liquidity. All right. So what does that mean? There needs to be a lot of people involved in the markets that you're working in. Otherwise, let's just take a credit spread, for example. All right. I mean, you understand the concept of liquidity in stock, right? If something's got a really, really wide spread, you might overpay to get in and then have to overpay again to get out, right? So if you do that with options, it can really add up fast. If you have really bad liquidity on a multi-leg strategy, for example, you're going to get chopped up here and you're going to get chopped up there. And then if you roll, you got to open a new position. So you're going to get chopped up here and here again. And then to close, you're going to get chopped up here and here again. You see how it can start to add up? You can give away your winnings in market makers eating you alive in the spread. So liquidity has to be a consideration. I don't trade options in stuff that has bad liquidity. If the liquidity is bad, I'll either do a stock position or I won't trade it. All right, so let's talk about what good liquidity looks like. I'm going to read through these and then I'll show you in the option chain what I like to look for. All right. So step one, the volume of the options. We want activity on most strikes, especially near the money. We want to see some option volume there. Okay. Now, if you look at that right at open, it's obviously going to be 0 because there hasn't been any trading for the day right at open. But you should see that start to pick up. And as you look throughout the day, you should see option volume, especially near the money. All right, open interest. Do you know what open interest is?
No.
That is how many contracts of that strike are being currently held open at any one time. All right, so if we look at the option chain here for a second, I can look at this. Let's just go right here to this at the money put on SPY here at 456. I have the volume column here. So that means, oh, the market just closed. I have the volume column there. So that means that we traded 3,000 contracts today of that 456 strike on SPY. But there are 5,400 open positions being held at that strike right now.
Okay.
So that's what open interest is. All right, this is how many trades were made. This is how many positions are currently open at that strike price.
Okay.
Which is really good. SPY has the best liquidity in the world. You're never going to find better than that.
So when the open interest is larger than the amount of trades that have actually taken place, that means there's more liquidity.
Not necessarily, but that's a good sign, yes.
Okay.
Now, what I'm really looking for with open interest is I want to see at least one line with 1K or more. And any zeros on the open interest line is a concern. I'm not saying it's a deal breaker. I am saying it's a concern. Notice how as we look at SPY here, okay, Every single strike on the open interest column has thousands or tens of thousands of contracts being held open. That's what you're looking for. That's what you want to see.
Okay. No
All right.
zero.
Let's see. What's a really illiquid, crappy stock? This is an example of bad liquidity. Zeros on the open interest line. We only had 4 contracts traded all day on any of the option contracts here. I wouldn't touch this with a 39.5-foot pole. There's just nobody in there trading it, which means you're going to have to pay the market maker to provide liquidity for you.
Yeah. When's animal gonna go to zero?
Boy, I mean, soon, right? It's trending down there. I haven't looked at the chart honestly in a little while. Yeah, it just does nothing but, this thing does nothing but go down. So,
Sad.
yikes. All right, anyway, that's kind of the idea there, the difference between liquidity, good or bad, okay? So, as I was saying, SPY's got the best liquidity in the world. That is the benchmark standard for liquidity, in fact. So that's what you want to be looking for. And then lastly, the last check. So I have 3 checks, all right? And once you get fast enough, you could do these in a matter of seconds. But good volume, good open interest, and then I glance at the bid-ask spread, and I ideally want it around 10% or less. All right? So what that means is typically I will look at the ask, okay, which is always the higher number of the at-the-money option, and you could do this on either the call or the put, doesn't really matter. All right, so the ask price of this at-the-money put here, this 456 put on SPY is 246. All right, if I want that to be 10% or less, right, that means, or I'm sorry, 1046. That means 1046 minus 10%, I would want a bid of at least $9.41 or higher.
Mm-hmm.
Does that make sense?
Yes.
Do I have a bid of higher than $9.41?
Yes.
Of course, absolutely, because SPY again is extremely liquid. Let me see here.
Would you put a limit order to buy at that price?
No, I'm usually selling.
Sorry, selling.
But I mean, to buy at what price? It depends. If I'm buying options, I like it. Sometimes I day trade options. I will just go for the mid price. All right. So if I wanted to go long on AMD here, I would click this 132 strike. The ask is 315. The bid is 305. So I would probably submit an order at 310 and then raise it by a penny until I get filled.
Right, I understand. I understand that you usually want to go with the mid, but if you anticipate that the position is going to go one way or the other, do you put a limit order at going that direction to get a better price?
Sometimes, yeah, not that often, honestly, because typically I'm looking at trades while the market is open.
Mhm.
And when I see the volatility opportunities, I'll usually just send the orders at mid price and adjust by a few pennies until I get filled. But if I were looking at it overnight and I had to account for what I think the chart might do, I might change the order a little bit. Yeah.
Okay.
Yeah. It's not something I do very often, but it does happen.
Okay.
Typically, I tend to manage a lot of my option trades through alerts. So I will typically set chart alerts, and then I will usually trade directly from my phone if I'm not at home. So I might get a chart alert. Let's just say, for the sake of argument then, that tomorrow I'm expecting a bounce in SPY because we're literally sitting on the 100 right now. All right. I don't know that that's the case, by the way. I'm not sure I would even prognosticate that because we just closed above this massive we just closed below that massive candle right there. This is looking really ugly for the bulls. I think we go lower, honestly. But let's just say, for the sake of argument, that I was expecting a little bounce. I might set a chart alert here because I don't know exactly what the option prices are going to be if SPY does get up to that level. So then if I'm in the middle of the day doing my thing and then I get this little alert, then I would go in and I would set the spread up and try to ship it at mid price.
Okay.
All right. So let's keep moving here. But anyway, so this is what the liquidity looks like inside the option chain. All right. Make sure you have volume and open interest as columns on your option chain. Now, if you're using Tastyworks, these can be customizable by simply clicking on them and picking whichever one you want. But any broker option chain should be able to allow you to change these columns to whatever you want, or they have a bunch of columns you can scroll through. Either way, at some point when you're setting up good option trades, you're probably going to want to at least glance at the volume and the open interest. All right. So check one was volume. So on AMD here, I'm looking at the volume today, and I can see that there's plenty of trading activity. We have thousands of contracts being traded on multiple lines, and right at the money, we have tens of thousands. So it looks great. All right. Open interest. Do I have one line with 1K on it or more?
Yes.
Of course. AMD is almost as liquid as SPY, which is why I day trade that one sometimes with options. And you can see thousands of option contracts being traded in here.
Yes.
And then we look at the bid-ask spread. All right. So I just usually my eyes, for whatever reason, tend to go to the first strike of the puts. I don't know why. That's just what I've always done. So because I'm usually looking to sell puts is probably why. So 272 is my ask price. 10% of 272 is 27 cents. So I already know that I could do 272 minus 10%, or I could just do 272 minus 27 cents. Either way, I'm getting a bid of around 245. So this is a little bit on the wider side, but not too bad. It's close. 272 minus 10%. Yeah. So it's close. That spread's a little wide, which is honestly not uncommon at the very end of the day. If you had taken a look at this like 30 minutes ago, it probably would have been fine. Sometimes the spreads get wide in the closing auction because there's just a lot of pickup in volume and movement, okay? And I think, unless I'm mistaken, we probably sold off into the close, which always tends to create a frenzy anyway. So liquidity for me is basically a kind of a 2 strikes and you're out rule. All right. So I checked the volume, looks good. I checked the open interest, looks good. The bid-ask spread was a little suspicious. All right. So we're going to X that one. But because these other two are okay, I'm going to go ahead and trade it. All right. But if, let's just say for the sake of argument that I were to check the volume and it was fine, but I didn't have a single line with 1,000 open interest. So that would have been a fail on the pass fail and the bid-ask spread was wide. Then I would be much more concerned about trading that particular ticker.
Okay.
So that's how I evaluate liquidity. As we used Amwell as an example already. All right. So in this one, there's no volume, there's no open interest, and the bid-ask spread. I mean, like the $2.50 puts, you're not going to get anything for those. But even these calls here, they're like 30% apart. You know, this is just a sloppy mess all over the place. What's another? Potentially, sometimes really expensive stocks can actually have deceptively bad liquidity because nobody's actually trading them, you know, because nobody can actually afford to trade them.
Right.
So if we look at this Amazon put here, this is 122.40 minus 10%. We should see a bid of 110 or higher. Okay, so that fits, I guess. Volume's a little bit lower, notice, compared to AMD, but there is trading happening. So not really a deal breaker. All right. And we do have a line with at least 1,000 open interest or more. So Amazon's fine, honestly. Another one that I sometimes had trouble with on the expensive stock side was like Google was sometimes a little wonky getting fills in there. This one you want to be a little careful on. We do have some trading going on, but there's no lines with 1,000 open interest. And well, the spread is acceptable. 1035 minus 10 is 93.5, so you're probably fine there. Anyway, so this is the process you kind of go through. Do you have another ticker? Just throw some symbols at me and let's check them.
Let's see ATVI. There's a lot of buzz about that today.
All right, ATVI. So first of all, I'm looking at volume, and I see tons of volume today, which is not surprising given the move on this one.
Yeah.
We do have lines with over 1,000 open interest. We actually have a lot of open interest on this one, so that looks good. Now, for the bid-ask spread, I can see already at an ask of 142, that means 14 cents is 10%. So if I subtract 14 cents from 42, I get 32, I get 20, I get like 28 or something like that. So 135 is fine, which means that ATVI passes on all three checks and is a liquid stock.
Okay.
Right, or is a stock, I should say, is a stock that has liquid options. Sometimes there's very liquid stocks that don't have any options or don't have liquid options, and you'll see that a lot in the cheaper tickers. Like Amwell, for example, is probably fine for trading shares. You're only 2 cents wide. That's a pretty liquid market, but the options in here just suck. I would never trade options in this unless I were going to like buy a leap and hold it for 2 years. That's about the most option trading I would do in there.
Mhm.
You got another one?
If it's even around up until that time, right?
Right, exactly.
Where's
Check,
Apple at today?
check another one. Apple. I'm sure this one is super, super liquid.
Super liquid.
Yeah. So we've got volume all over the place. Looks good. We have at least one line with 1,000 open interest. We have like every line with 1,000 open interest, so that looks good. 475 is the ask on the at the money put. So 475 minus 10% gives us a 428 bid or better. So since we have 445 there, we should be more than fine. So that Apple passes with flying colors.
How about F cell?
F cell. No options. Oh, wrong symbol. FCEL. There we go. That's probably better. All right. Anytime you see weekly options, that's usually a good sign. But let's just double check here. So we've got some volume at the money, which is good. Whoopsies. Wrong color. So that's fine. We do have at least one line with 1,000 open interest, so that's also good. And then the bid-ask spread is a penny on 20 cents. So I would say these options are pretty liquid. If you now, I mean, the ticker's really cheap, but you can see this stock has the same price as Amwell, and there's a huge difference in the option trading market, right? You can see that.
Mm-hmm.
These options are way better and way more liquid than the Amwell options are, because I think everybody's just kind of left that one for dead at this point.
Yeah, Amwell's dead. F cell still has some life in it.
So it would seem.
Yeah.
All right, so I think that's good enough. We get the idea on liquidity. All right, so I need to pick up the pace a little bit here.
Okay.
So let's go through these rules and then we can ask questions. We can ask questions, review a little bit tomorrow and get into debit spreads, all right?
Yeah.
So the rest of this is basically stuff that's been researched by MIT geniuses much smarter than me. I didn't invent a lot of this stuff, but I did study it and curate it for years and basically distilled it down into this checklist for you, okay? So basically what we have here is whenever people are trading options, there's always a lot of confusion around what strike price to choose, what expiration to choose, what strategy to choose. So my goal in this course is to demystify some of that for you. All right, so if you've decided to go bullish or bearish, you can do it either way, and you want to do it with a credit spread, which means you're selling options. First of all, again, you would probably do it in something with really high IV rank. And you would check the liquidity to make sure that you're going to get good prices. All right. Then what you want to do at that point is you want to go out 45 to 60 days. I usually trade the monthly cycles for simplicity and liquidity, but I won't go past 60 days for a new trade. All right. So that means that means when I'm opening new option trades, I am not selling options a week away. All right, there's not enough time to adjust if something goes wrong. But I'm also not selling stuff 3 years away because it's going to move way too slowly. I'm not going to get paid in any reasonable amount of time. 45 to 60 days is the Goldilocks wheelhouse, the one that's just right. Now, in this case, March is just inside 60 days. So that's actually the strike we should be trading at this point as of today, honestly.
Okay.
Yeah, so I'm looking to put new trades on in March, and in a couple of weeks, any February trades I have will probably roll into March, because this is where the optimal curve is for theta right now. All right, and I'll get into that a little bit more when we talk about spread management next week. All right, next you're going to choose your strikes. Let's just say, for the sake of argument, that on today, on AMD's down day, I wanted to sell a credit spread on AMD. The best place to start, again, this is just based on research and back testing, is usually the 30 delta. All right, this is why, in addition to volume and open interest, I also have delta on my option chain. We talked about delta a little bit last week. It's a numerical representation of your directional risk. So the more delta you have, positive or negative, the more risk you have, positive or negative. Positive delta means you're bullish, negative delta means you're bearish.
Okay.
All right. So typically the 30 delta is where I will start to set up my spreads. All right. So I'll usually sell a put there, and then I'll buy the next put in line for what I want for a strike width. Now, how wide you go depends on a lot of different factors. Usually how much premium you're getting paid is the biggest one for me that determines my strike width. But account size also factors in. All right, if you sell a $30 wide spread, you better be prepared to lose $2,500 if that thing finishes fully in the money. All right, whereas if you sell a $5 wide spread, you're only going to lose $338. All right, so again, risk is relative. Everybody has a different tolerance. Everybody has a different account size, et cetera, et cetera. What I will say in terms of this is
Probably
wider.
start off smaller to get your bearings in this before you want to take on a bigger chunk.
Yeah, but also premium evaluation is going to be the biggest factor. All right, and I'll get into that in a minute. But wider is better if you have the account size for it, because the wider you go, the more that it'll behave like a naked option, but without the risk of a naked option, if that makes sense.
Okay.
All right, this is why I never ever personally trade $1 and $3 wide spreads. They're too, the margins are too small. You're going to get chewed up in commissions based on the winnings that you're taking out of that trade. All right, $5 wide is usually about as small as I will go personally.
Okay.
All right, so in this case, we have a $5 wide spread at the 30 delta on AMD, selling at the 120 and buying at the 115, and I'm getting paid $1.62 for that. Now, if I didn't like that premium, I could move it one strike closer to the 36 delta. Now I'm getting paid $1.95. Or if I thought that was really rich and I wanted to back off a little bit, take a little bit less directional risk, I could move it to the 115, which is a 24 delta, and get paid $1.30.
Yeah.
I start at the 30 delta and I try to shoot for the 30 delta for optimal, but sometimes I will adjust these based on what premium looks like. All right, so let's talk about what good premium is. Okay. Don't go past the 39 delta. You're basically selling at the money options at that point, which starts to mitigate your statistical advantage. All right, evaluate the premium for good risk reward, which means this is the basic rule right here. Always get a third of the width of your strikes. So if you sell a $10 wide spread, you should get paid $3.33 or more. If you sell a $5 wide spread, you should be getting paid, okay, $5 wide spread. Sorry for the chicken scratch. The kindergarten drawing. $5 wide spread equals $1.65.
Right.
I will not sell a $5 wide spread for less than $1.65 because the risk reward does not support it, statistically speaking. Now, if you're a master charter and you want to sell a $10 wide spread for $1, which I know guys that do that, That is one way to go. The problem is you have to win 9 times just to count for that 10th loss. Because if your $10 wide spread goes fully in the money and you get out for $10, but you sold it for $1, that means you lost $9 on that trade. So if you make $1 for every spread you sell, that means you have to win 95% of the time or better to make money, because that 10th spread's going to blow away 9 of the previous winners. You see the math there?
Yes.
So this is why I tend to get a little bit closer to the money, but that's because I trust the probabilities. Okay? So risk reward is a conversation at every level of this style of trading. All right? You can take a lot, or you can, excuse me, out here you may not feel like you're taking a lot of risk, but if something goes wrong out here, it's going to blow you up. The downside is way bigger than the upside to an obnoxious degree. Conversely, if you're too close to the money, like you sell way down here, you might be getting a lot of premium. You know, like I can go, let's see how far, I can go way in the money here and sell a $5 wide spread for 425. The problem is the odds of that spread actually expiring worthless to a point where you get to keep that money is very, very slim. According to Tastyworks, it's actually at 12%. So that doesn't work either. This is way too much risk. You're getting paid for it. You're getting paid well, but it's way too much risk. Out here, you're not making any money. 1 penny, that's not worth any risk. So you got to be somewhere in the middle, and the 30 delta has been researched to be the optimal strike.
Okay.
Now, if we apply our rule of 1/3 the width of the strikes, we're very, very close here. $1.65 is what I'm going for. I might be willing to take this trade at $1.62 if I really liked AMD's chart.
Okay.
But I would be fine selling the 36 delta, which is a little hot. All right, that's a little bit closer to the money, but I'd be okay with it. Selling the 36 delta at 125, 120 and getting paid $1.95. You will see when I do the chart management class next week, Sean, and I start breaking down how to manage credit spreads, you will see how advantageous it is to get a good, healthy credit up front. Because if you can do that, it gives you a lot of flexibility in what you can do down the road to defend the trade. Okay? All right. So either one of these, this one is close. I might try to get a penny or two more, but this one is, if I really liked the chart, I might sell this one. I'll get a lot more money for it, but it's a little bit risky. It's a little bit closer to the money. Either one of those is honestly fine. Okay, so let's talk about position sizing. What time is it? Yeah, I'm running out of time, but I got about 10 minutes here. Let's talk about position sizing. Again, I know this is a lot of information. All right, and I'm just kind of fire hosing it at you right now. So watch the class and we'll discuss it throughout the week. And then when I talk about management and defense next week, I think a lot of it will make more sense at that point, okay? For now, I'm just giving you the guidelines. All right, 3 to 5% is position sizing. So a lot of people ask all the time, how many contracts should I sell in the first place? And this is where kind of risk management and risk mitigation really play a role again. In real life trading, how do we control our risk when we buy stock? In a standard trade, how do we control our risk?
To hedge.
That's one way. But if I'm just getting in and out for a day trade, what is my method for controlling my risk?
Your stop loss with your number of R's, you mean? Is that what
Exactly. Yeah. It's your R size and your stop loss, right? So we don't really have a stop loss in option trading. Okay? That's not really how it works. The stop loss in option trading tends to be more around timing. All right? What happens when, alerts, that kind of thing. There really isn't a functional way to put a stop loss on a spread, because you're going to end up shortchanging yourself against the probabilities if you try to do that. And I actually don't think you can even put a stop loss on a spread in most brokers. Like if you went in and tried to do a stop market close on a spread, I don't think they would even take that order. So what you need to do is come up with management techniques and risk mitigation techniques that are different. All right. So strike selection and expiration selection all goes into that. Setting up the trade properly. Okay, everything we've talked about thus far. But then next week when I talk about how to defend a spread, you'll see some more ideas. But for now, one of the key ways that you can defend yourself against a losing trade with options is proper position sizing. All right. And that comes down to how many contracts you buy or sell. And my general rule of thumb, well, again, the general rule of thumb that is commonly taught is around 3 to 5% for selling options. All right. Now, in real life trading, when we're buying stock, we teach an R of 1 to 2%. But remember, on credit spreads and in option selling in general, you're taking on more risk than you can stand to gain. Now, with good management techniques, you're not likely to actually realize a loss of 3 to 5% of your account on one trade. All right. Especially with the rules that I have, that almost never happens. But you do need to be prepared for losing some trades. So you don't want to go too big, but you also don't want to go too small. 3 to 5% is the right number for selling options. So what that means is that what I'm talking about there is the percentage of your net lick, or what your total account value is. So let's pretend this is a 100K account. Okay? 3% in that situation would be what?
$1,000.
$3,000. Yep. So I would sell enough of these to have the buy power effect equal $3,000. And that would be roughly 3% of my account. So in this case, I'd probably sell 10 of these spreads.
Okay.
If I had a 100K account. And you just adjust based on your account. If you have a 10K account, guess what? You're only selling one. You're selling one contract.
Right.
Okay, so that's kind of how the scale goes for position sizing. Okay, now this is the last step I'm going to talk about in terms of setting up a trade properly. And then tomorrow I'm going to talk about how to set up a debit spread properly, which is a completely different style of trade. But the management rules are similar. There's some overlap there. So that's why in next week's class, we will go over all of the ways to manage vertical spreads. That's what we're doing here. We're trading vertical spreads. We're selling credit spreads. Tomorrow I'll show you how to buy debit spreads, and we'll go from there. Okay? So once I have gotten a fill on my spread, I immediately go to that position. I right-click it and say close, and it brings up an order to close that trade. All right? And what I will do then is I will set the time in force to be good till cancel, and I will set the order for 50% of the credit I received. So if I sold the spread for $1.95, okay, 50% of that divided by 2 equals 98 cents. So I would set a good till cancel order to close this spread at 98 cents. And I would send it and let it just sit there and work in the broker. And that is my target. Anytime I'm selling options, I'm always looking to get 50% of the premium that I sold it for.
Okay.
Okay. I have a couple minutes for questions on credit spreads.
The orders are buy to open and sell to close, and
Well,
sell to close and buy to open upon, right?
if you're selling options, if you're selling a naked put, or if you're selling a credit spread, you're actually going to sell to open the spread, and you're going to get paid a credit to do it.
Okay.
But because it's a multi-leg strategy, Sean, you're going to have both orders in there. So this is going to be sell to open this option, and this is going to be buy to open that option. But you're going to do it in the same order window right here.
Right. Okay.
See how that works? You just have to make sure that you're getting paid a credit if you want to trade a credit spread. Because if you are trying to trade a credit spread and you notice that you're paying a debit, you done messed up, Ron. All right. What that means is you got your strikes reversed. So double check your order.
That's what I wanted to make sure. Yeah. Okay.
Okay. Make sure if you want to sell a credit spread that you're actually getting paid a credit to do it.
Okay.
So if you want to sell a put spread, the put that you're selling is always the closest one to the money. If you want to sell a call spread, let's say you're bearish. You think AMD is just going nowhere but down from here. So you want to sell a call credit spread because you want to short AMD. If you're doing a credit spread to the call side, the call that you're selling needs to be the one that's closest to the money. And make sure that you're still getting a credit. So you can trade credit spreads either bullish or bearish. The rules are the same in every situation. So I actually wouldn't trade a call spread here because I don't like the premium. I'd have to go all the way to the 38 delta. Even then, it's not enough. And that's because the market is being priced as though we're going lower from here. So you'd have to take on a lot of risk to short AMD here, and I wouldn't be willing to do that. I'd have to use a different trading vehicle. If I wanted to short AMD, I'd have to use a debit spread. But if I wanted to go long, I could do a credit spread with puts.
Okay.
Other questions?
No, I hope I asked enough questions to answer everybody's questions who's going to be watching the recording.
Hopefully. If not, post them in Slack. All right. Go back and watch the video again. Don't feel like you have to watch this again before tomorrow. Tomorrow's going to be a totally different trading strategy, and there will also be some review on a lot of this. So everything from here up is the same with debit spreads. And then from here down, it starts to get different. So it's one strategy, then another strategy, and then I'll teach you how to manage them both next week.
Okay.
Sound good?
Yeah, sounds good.
All right, man. You have a good afternoon. Let me know if you have any questions. Anybody watching the recording, reach out as you're going through this. And I will see you guys tomorrow, hopefully.
Tomorrow morning. Yeah, right now.
Tomorrow at noon Eastern, okay? Which is, which is 11 Central, 10 Mountain, 9 Pacific.
Right.
All right, have a good one.
You too. Have a good night. Bye-bye.